Hi everyone, this is Demel Gonzalez with Heartwood Financial Services. Welcome to our quarterly update, second quarter 2019. So the first quarter went pretty well, and I'm happy to report some good numbers for everybody. If you haven't gotten your statement yet or seen it, you'll probably be pretty happy with the results. So I'm going to go over some of that. And also just wanted to see how everybody did with their taxes. I'm glad I'm done with mine. Hopefully you're done with yours or just finishing them up. I would love to hear from you how they went. There was a big tax change for 2018 and hearing some mixed results, but more on the good side. So let me know how that goes. But enjoy the video and enjoy the music from Sam, who created the soundtrack for the video. Thanks. The agenda for the video today is going to be to go over the first quarter returns. So I'll show you how everything went, the different asset classes. Also just give you a current update on where the market is right now, the valuations, things like that. And also in the news has been a lot of talk about the inverted yield curve. So I'm going to give you some insights on that. And of course, as always, give you my thoughts on expectations going forward. Okay, so here are the asset class returns. And for those of you that don't have the best eyesight, I do apologize. When I put this on the video, it does get a little blurry. But if we start at the top, real estate was up the most for the quarter at 17%. Small cap stocks at 14.6%, and that's U.S. small caps. U.S. large caps 13.6%. Developed market equity, or international, up 10.1, emerging market equity at right around 10, an asset allocation portfolio, which is what the line is showing, is about 9%, high yield or junk type bonds 6.3%, and commodities up 6.3 as well. And then bonds in the general fixed income category about 2.9%, and cash about 0.6. So as you can see, pretty much everything was positive. What we're seeing now is the Fed making a pause. So interests have stayed the same. They have not been going up. That's been helping fixed income. But also you've seen a nice generation of returns in really all the asset classes. A couple quick interesting notes though. When you look at this chart, it's kind of a spattering of all these different colors. And part of the point is that there really isn't much of a trend when you look at this, which is what makes this hard to figure out as far as what's going to be the next best thing, right? But if there's one thing that you can get from looking at these charts is that oftentimes what does poorly, so you can see emerging markets here has done pretty poorly for a while, can sometimes turn around. We saw that in 2017, 2018 not so much. That was a continuation of bad, but then coming back year to date. That's one of the areas that I feel is going to have a nice comeback going forward. If you look at the column here, historically speaking, for the last 14 years, emerging markets has actually been one of the best performers. The other interesting thing is real estate. If you look at real estate has done very well over the last few years and has actually been one of the best performers. So this goes to show you the importance of having some real estate in your portfolio, either directly an ownership or through a REIT, like what we use here at Heartwood. And so, yeah, if you have any questions or if you need for me to send you the actual chart so you can see it better, happy to do so, but happy to report some great numbers for this quarter. Thanks. So where are things right now? Well, I always like to look at the leading indicators. The leading indicators are all the different economic figures that show or give us signs of what's coming ahead, not just looking behind. And so when you look at this chart, which I showed you last week, or last month I should say, right here in the top right quadrant is what's expanding, okay? And on the left is also what's expanding but is starting to decelerate. So what you could see from last month, we have pretty much everything is expanding, but several things were starting to decelerate. The little red dot here is kind of the average of where everything is. And then this red rectangle here shows where historically the average would be when a recession begins. And so that's where we were last month. Now let me show you here where we are right now, as of April 5th, that is. So when you look at this, you can see that still everything is in the expansion category. If anything, some of the leading indicators look like they went up a little bit, but a lot of them are still in that declining expansionary quadrant. So the bottom line, things look about the same, still pretty positive, starting to slow down a little bit, but overall still a nice expansion at this point. Now here are the updates for how the market is valued right now. So when we look at this chart, I updated this yesterday, and the earnings estimates have been coming down a little bit, which I reflect in this row right here, which shows earnings growth for the year coming down. So there have been some negative revisions. Now we'll see. There's still hope that things will end up a little better than what they're projecting, because sometimes analysts tend to be a little pessimistic and hope that companies will do better than expected. But if you take the math here again of this growth where we are currently, you could see that currently we're at about 28.95. Now it's down a little bit today, but this is where it was yesterday. And what I'm projecting based on historical PE ratios and the earnings estimates, we should be somewhere in the 27.15 range. So I'm showing the market right now slightly overvalued, including the dividends. We're still maybe about 4% higher than we should be. So right now what I'm seeing is that there is some optimism based on maybe the China trade deal, maybe Brexit. Maybe earnings are not going to be as bad as some analysts are projecting. That's built into the market. If not, and these things do continue to persist, then you might see a correction in the market. Maybe a 4 or 5%, although oftentimes you know how they can be a little worse than they should be. And so you'll probably notice in the portfolios I have been trimming back just a little bit, because I'm looking at the market as being pretty fairly valued, pricing in some good things that may or may not happen. I hope they do, and I think a lot of them will. So we might see earnings revisions go back up, but you never know, and you gotta kind of play it safe, which is what we're doing. Hi, so the yield curve. There's been a lot of news about the yield curve lately. I wanted to talk a little bit about that. This chart here shows you how the yield curve has been flattening. So when they say flattening, you can see the blue is January 2016, and then the light blue 2017, green is 2018, and red is roughly around now. So what you can see is the short-term interest rates are going up. Longer-term interest rates really haven't changed very much, and that's mostly because the Fed has been raising short-term interest rates. They can't control the longer-term interest rates as well. They really only control the short-term interest rates. Now, what you can't see here, because my chart doesn't show a short-term like a 90-day T-bill, the 90-day T-bill is actually right around 2.4, 2.5%. And so when you look at the 10-year is actually right around that same amount. So we actually got what's called a yield curve inversion a couple weeks ago, and the yield curve inversion means basically the short-term rates are higher than the long-term rates. Now this could be a rather ominous sign, because that means that people anticipate the economy to be slowing down. They're also assuming that the Fed will be lowering rates instead of hiking rates, which could be an issue, but that remains to be seen. What happened is this yield curve inversion is actually not even in place right now. So it was a short-term phenomenon. It could happen again. We'll have to see. But I want to talk a little bit more about what does happen if there is a yield curve inversion and what are the ramifications to the market. Okay? Okay, so let's say we get a yield curve inversion and it actually it persists for more than just a few days. And this chart here shows an example of what would happen when it has at least 10 days of an inversion. Now this has happened in the past, and just so you know, every time there's an inversion of the yield curve, that doesn't mean there's going to be a recession, but it's actually been a pretty good indicator. I believe 6 out of the last 7 times it's been correct. So here's an example of some different dates when this happened, as you can see on the left, and then when the actual recession took place. Now, the good news is that there's not a recession that occurs immediately. Okay, you can see from this chart that the recessions usually take 6 months to 18 months, on average close to a year to actually take place. And so what's interesting is even after there is an inversion of the yield curve, we could still see positive returns in the stock market for weeks, months, even years. In fact, some of the best returns have come after a yield curve inversion. The average return on the market before the market goes into recession after a yield curve inversion is about 10% plus. And so I don't want you to see the news, see this yield curve inversion and start panicking. It's certainly a sign that things are slowing down, which is hard to argue that right now, but is not a sign that things are going down the tubes as well. But it is a sign to probably become a little bit more cautious, which certainly we are. So up to this point, you might be thinking, wow, Demel's shown me a lot of things that are getting me a little depressed. He seems kind of pessimistic. Now, actually, that is not the case, although I do have to be realistic and kind of show you where we are. But I do think there are some positive signs coming ahead. I've shown this chart in the past, and I want to show the updated version of it again to show some of the areas, or one particular one that I feel is very promising. This is the international stocks. Now, the gray line here shows the S&P 500, and you can see that it's been running along with the purple line, which is everything but the U.S. stocks, looking at global. And it's been doing about the same until around 2009, where there was quite a divergence started to begin. And over the last 10 years or so, U.S. stocks have done much better than the international stocks. Now, there's a lot of reasons, and I don't have enough time to discuss that right now, but you could see that the valuation of international stocks look a lot more attractive than they have in recent history. In fact, when you look at this chart right here, which shows the valuation historically versus where it is right now, the S&P is at 16, where historically it's at 15.8, 16.4 that is. And the global world outside the U.S. is at 13 versus 14 normally. And so you could see that there's really a nice valuation difference there for international stocks. Now, the international stock valuations may not tell us that it's going to start beating the U.S. stocks tomorrow, but in the long run, valuations do matter and they do affect the long-term performance. The other thing to point out, too, is the dividend yield on international stocks are also more attractive at 3.5 than the U.S. at 2.1, and they're actually higher than they have been historically as well. So you can see there's a couple different reasons to be interested in the international area. And so you might see that I've been continuing to hold international, I've been bumping up a little bit of the exposure there, while keeping, again, quite a bit of the U.S. exposure, But I see this as an opportunity for the next 5 to 10 years, and I'll make sure to have exposure to that. Well, you know me, I always like to end with some sort of inspirational message. I hope they're inspirational at least. As you can see here, this is a beautiful picture that I found online, and kind of makes me wish I was there right now. But the message here is, the heavens are yours, and yours also the earth. You founded the world and all that is in it, in Psalms. And the point here is that sometimes when things are going our way, we feel that, you know, it's all about us and we did it all ourselves. And I just want to remind you that pretty much everything that we accomplish, everything we have, our health, our talents, our family, a lot of our blessings, pretty much all of our blessings, they come from God. He owns it all. And to be grateful, thankful, and to remember where your successes come from. And so that's the message I'd like to leave with you guys today. Thank you so much for watching the video. Hope you enjoyed it. Hope you enjoyed the music that my son put together. And I hope you guys have a wonderful Easter.